Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate speak and financial jargon to find out what is really going on. And today we have a real treat from Phillips Edison and Company, PECO for short, with their third quarter report for 2025. Get ready. Because this Q3 filing has some numbers that tell a very interesting story about their real estate game. First off, make sure you are subscribed and join our Discord community, linked in the description below. You will not regret it. Alright, let's dive straight into the heart of it with their financial picture. We are looking at their balance sheets, which give us a snapshot of what they own and what they owe. Right off the bat, their investment in real estate assets is massive, standing at over $4.9 billion. That is a huge amount of property they own. This net property value has climbed from about $4.8 billion at the end of last year to over $4.9 billion. Now, showing they are definitely adding to their portfolio. Now, owning all that property comes with a price, and that price is debt. Their debt obligations sit at a hefty $2.38 billion. This has also increased significantly since the end of last year, which was around $2.1 billion. So they are borrowing more money. Let's move on to how they performed financially over the last quarter and the first 9 months of the year. This is where we see if all that property is actually making money. For the 3 months ending the 30th of September 2025, their total revenues were over $182 million. That's a nice jump from about $165 million in the same period last year. And looking at the bigger picture, the first 9 months of 2025 brought in over $538 million in revenue. That is a solid increase from about $488 million in the first 9 months of 2024. This shows their core business of renting out space is doing well. But what really matters is the profit that goes to the owners, the stockholders. For the 3 months ending the 30th of September 2025, net income attributable to stockholders was about $24.7 million. That is more than double what they made in the same quarter last year, which was just over $11 million. And for the first 9 months combined, they earned almost $64 million for their stockholders. That's a big jump from about $44.5 million in the same period in 2024. So profitability is clearly on the upswing. Now, you'll notice a big number here called depreciation and amortization. For the 9 months ending the 30th of September 2025, this stood at over $202 million. This is a non-cash expense that accounts for the fact that their buildings and improvements lose value over time. It is a significant number, but it doesn't mean they are losing actual cash on that amount. In terms of cash flow, which is how much actual cash is coming in and going out, things are also looking positive. Over the first 9 months of 2025, they generated over $252 million from their operating activities. But investing in real estate is a cash-intensive business. They used over $375 million in investing activities, largely on real estate acquisitions and capital expenditures. That's significantly more than the nearly $260 million they used in the same period last year. To fund all of this, they've been actively managing their debt. They brought in over $540 million from their revolving credit facility and paid back over $577 million. So they are using this facility quite actively to manage their cash needs, borrowing and then paying back amounts. They also raised a substantial $346 million through notes payable in 2025. All this debt comes with interest costs. For the 9 months ending the 30th of September 2025, their net interest expense was almost $82 million, an increase from about $72 million in the same period last year. This higher interest expense is directly linked to having more debt outstanding. Let's look at how their existing properties are performing. Their same center net operating income, or NOI, which measures the profitability of their properties that they have owned for the full comparison period, increased by 3.3% for the quarter and 3.8% for the first 9 months of 2025 compared to 2024. This is a good sign, showing their core established properties are generating more income. Now, a key metric for REITs is funds from operations, or FFO. For the quarter, their NAREIT FFO per S-share was 64 cents, up from 60 cents last year, and for the 9 months, it rose to $1.9 from $1.76. This shows their operational profitability is growing. Their core FFO per S-share also saw a good increase, moving to 65 cents for the quarter and $1.94 for the 9 months. This metric adjusts for certain items to give a clearer picture of sustainable earnings. When we look at EBITDA, which is essentially earnings before interest, taxes, depreciation, and amortization, Their results are also strong for the 9 months ending the 30th of September 2025. It was over $349 million, up significantly from about $315 million in the same period of 2024. And their adjusted EBITDA, which further refines this number by adjusting for certain items, also shows a healthy increase, reaching over $353 million for the first 9 months of 2025. Now, let's talk leverage. Their net debt to annualized adjusted EBITDA ratio stands at 5.3 times. This means it would take them roughly 5.3 years of their adjusted earnings to pay off all their net debt, while this ratio has increased from 5.0 times at the end of last year. They are still within a manageable range. This shows they are managing their debt effectively, but are carrying a noticeable amount. Their net debt to total enterprise value is 34%. This means that about a third of their total company value is made up of net debt. This ratio has also increased, indicating a slightly higher reliance on debt relative to their overall market value. Looking at their leasing activity, which is crucial for a retail property owner, they are keeping their occupancy rates high. For the 9 months ending the 30th of September 2025, their leased occupancy was 97.6%. This means almost all their space is rented out. The comparable rent spread for new leases in the 9-month period was 29.5%. This is a very strong number, indicating they are able to charge significantly higher rents on new leases compared to the old ones for the same space. This is a great sign of pricing power. And importantly, their portfolio retention rate was 92.8% for the 9 months. This means they are successfully keeping most of their tenants when leases expire, which is generally more cost effective than finding new ones. Now, looking beyond the 30th of September, they've been busy. They made 2 property acquisitions and bought a piece of land for future development for about $74 million. They also sold 1 property for $9.6 million. This shows they are actively managing their portfolio, buying and selling to optimize their holdings. Now, let's zoom out and look at the bigger picture. Phillips Edison and Company, PECO, is doing a solid job in a challenging market. They're growing their revenue and, more importantly, their profitability. Their core business of owning and operating grocery-anchored shopping centers seems to be performing well, especially with rising rents on new leases. The high occupancy rates and strong tenant retention are definite strengths that show they have desirable properties. However, the increasing debt levels, while managed, are something to keep an eye on. The increase in interest expense is a direct consequence of this, and while their debt to earnings ratios are still acceptable, they have moved in the wrong direction. The significant investments in acquisitions and development also mean continued high cash outflow, which they are funding through debt and credit facilities. In my opinion, PECO is navigating the current economic climate quite well. Their focus on necessity-based retail, anchored by grocers, provides a degree of resilience. The ability to raise rents on new leases is a testament to the quality and location of their portfolio. The key challenge will be managing their debt load while continuing to invest for growth and maintaining profitability. They seem to be balancing this act right now, but it is a continuous tightrope walk in the real estate sector. Alright, that is our breakdown of Phillips Edison and Company's latest filing. What do you think about their performance and their strategy? Let me know your thoughts in the comments below. If you found this analysis valuable, please hit that like button and subscribe for more deep dives into the world of corporate finance. And don't forget to join our Discord community. The link is in the description. Thanks for watching, and I'll see you next time on Corporate Decoder.